We have to find the market capitalization again using the dividend valuation model once again. So again, we have to find growth here. You see, the latest dividend is given. Um, he gave us latest dividend, current return. No, I don't think so. We can find the growth model. We will find the, we will use the Gordon growth model here. Okay, why? Look, you see, he gave us the EPS as well. Current return, return earned on asset. So return on asset is given. Look, so basically we have to use the Gordon model first, which is G is equal to B multiplied by R. R is your return on asset, return on capital employed, which is given by the way here, 20%, if I'm not wrong. Oh my God. Yeah, so 20%. So this is 20%. Okay, how we will find B? He mentioned somewhere current retain, okay, return on is given. Okay, we can find it, by the way. How? Look, how much earning, how much your EPS per share? What is your earning per share? And how much you pay as a dividend? So out of, you earn 25 cent of profits for one share. Out of it, 18 cent you pay as a dividend. So how much is remaining, which you retained? I think 7. Yeah. So to find the R, we have to do 7 cent out of 25 cent, right? So 7 over 25 multiplied by 100 will give you retention rate, right? So how much we get? You're not bringing your calculator? 28%. 28% is the retention rate. Okay? 28%. So what is my growth? 28% into 20%. 5.6% is my growth. 5.6% is the growth. Then we have to find KE using the CAPM. RF is given 5%. Beta is given. Beta of this sector is high, 1.1. Into RM minus RF, 12% minus 5%, so 7%. So KE is 7 into 1.1 plus 5, 12.7%, I think. Very high. Okay, now we can find the price of share, and we can find the market cap as well. Okay, how we can find the price here? Let me find out. So the price, you can find this here. So current dividend is mentioned 18 cent. So 0.18 into growth. Growth is 5.6%. So 1.056. Cost of capital is 12.7%. 0.127 minus 0.056. And then you can find your answer, right? Yeah, so B is 28%. Yeah, that's what I did. So 268 cent are $2.68. our price per share, $2.68 per share. You want to find the market cap, so multiply with 2 million shares. Okay, so $5.36 million is the value of this company. Okay, so value of the company is basically value of equity, right? The value of equity is the value of the company. The next method is cash flow based valuation of the company. We can call this free cash flow method. So we have to find the value of business, or we have to find the value of equity. Basically, in asset based valuation, or even in price earning based valuation, or in dividend valuation, what we are trying to find? We are trying to find the value of equity, right? But this method, whatever we use, we will find the value of entire business, which is the value of equity as well, plus value of debt as well. The following information has been taken from the statement of profit or loss and the statement of financial position. Okay, we have revenues, we have production expense, we have administrative expense, so definitely we subtract. We have tax allowable depreciation, the same we learned before in investment appraisal. We have capital investments, this is our capex. We have corporate debt information available, tax rate is there, VAT is there, inflation is there. The cash flow are expected to continue every year for the foreseeable future. We believe that these cash flows will remain same every year for a foreseeable future. Right? In reality, look, it's very easy to do a free cash flow question in exam, but in real world, definitely it is very difficult to forecast these future cash flows. What's the growth? By the way, here we have no such growth, but if the growth we have to find out, it's very tricky and very technical kind of calculation you have to do. But once you able to figure out your cash flows, your forecasting properly, you can find the more realistic and more reliable market value of the business. Okay, let's try this question, and we are going to find the value of company using this approach. We have 3 steps approach to find this way. The first step, we have to find the free cash flow to firm. Okay, so step 1, we have to find what? Free cash flow to firm. Normally we call this FCFF. So what is free cash flow to firm? The cash flow which is freely available to business before any dividend payment, before any interest payment. So cash flows which is freely available to all the investor, right? We call this free cash flow to firm or free cash flow to business. Okay, so how we will find? Take all the cash flows, revenues, assuming they haven't mentioned that. So assuming these revenues are cash revenues, production expenses, administration expenses, so I will take all of them. Okay, so I will take revenue, production expenses, and administration expenses. $1 million. Okay, so how much revenues we have? 350. Production expenses 210. Admin expenses 24. Okay. No, tax allowable depreciation. Should we subtract it? Look, depreciation, it is not a cash flow. But tax saving on the tax allowable depreciation will be a cash flow, right? So same idea, the same principle that we learn in our investment appraisal. So how we have to deal with tax allowable depreciation? We have two approaches. Either because we need to take tax as well, right? So for tax calculation, we can deduct depreciation first. We will find tax and then we can add back our depreciation, right? Either we can do like this or simply find the tax saving on capital allowances. Both ways are fine. So I will follow the second easiest way. First of all, okay, I will find out here our operating cash flows. Let's say this is our operating profits, our operating cash flows, let's say equal to cash flows, because we have no information of any thing here. So operating cash flows, and I will find tax on it. So tax is 30%, right? 30%. Look, don't subtract any interest payment from here, even if it is given, even for the tax calculation, right? Because we are not taking any, we are finding the free cash flow to the business, to the firm, before any debt payment. Okay, so we will find the tax on these profits. So this times 30%, and we have to subtract from here. Okay, okay. Now you can add back, you can add the tax savings on tax allowable depreciation. I can add it here. Simple, just like we did before. So we have capital allowances that we can claim every year. He mentioned is 31 million into 30% tax rate. So it's an inflow, 31 million into 30%. This is my tax savings, 9.30. We have capex as well, yeah. Capital investment each year, 48 million. We also have to subtract capital investment or capex, 48 million. Because what is the idea behind free cash flow? Free cash flow means cash flow which is available to company after every mandatory expense. Okay, 48 million you have to spend every year for the capital expenditure. This is not freely available to the firm. So free cash flow mean what? Free. Free mean which is available to the company, which is not mandatory to invest anywhere. That's the idea behind free cash flow. Okay. So that's why even capital investment or any enhancement in working capital, if it's necessary, any kind of capex, we have to subtract. Okay. So I think so. We have no other thing left. Don't subtract debt from here because we are finding the value of business, not the value of equity, first of all. So yeah, so this is my operating cash flows. Yeah, minus tax plus tax saving and minus capex. This is the free cash flow to the firm, or the free cash flow to the business. Okay, you can also call it free cash flows to business. So in first step, we have to find our free cash flows to business. So we find out our free cash flows to business. Second step, you have to find your WACC. By the way, WACC is given here. Because we are taking the cash flow to all the investor. So we are going to use WACC, which is the cost of capital for all the investor. Right? So we are going to find the WACC. And usually, when we are doing the business valuation, and for that purpose we are using the WACC, we need the real WACC. Keep in mind the calculated WACC is always the nominal WACC. The given WACC, if it is not properly mentioned, it is the nominal WACC. Nominal WACC means the WACC with inflation. We need real. Okay, so look here, he gave us the WACC and he gave us inflation as well. Why? Because he wants us to use Fisher formula. He wants us to use the Fisher formula to find the real WACC, the real cost of capital. Remember, if nominal WACC is given, nominal cost of capital is given, so using Fisher, we can convert into real. Okay, so WACC is, by the way, given, but it's nominal WACC, right? So how can we find the WACC? So I can show working here, by the way. So formula for the formula, okay, you know that Fisher formula is 1 plus M is equal to 1 plus R into 1 plus I. So you want to find the real, right? So we have to rearrange the formula. So if you want to find the R is equal to, so 1 plus I will come on that side. So 1 plus M over 1 plus inflation and minus 1, right? Because N, we have to find R only. So 1 we have to take on the other side. Okay. Money WACC is given, which is how much? 16.6%. So 16.6 mean 1.166. And what is my inflation rate? 6%. 1.06 minus 1. Okay, find the R. Okay, I'm finding here. So 1.166 divided by 1.06 minus 1. 10% exactly. So my WACC is 10% here. Okay, now step 3, find the value of business. Okay. Find the value of business. Okay, how? We have the free cash flows, we have the WACC, and what is mentioned in the question? We expected that these cash flows will remain same for the foreseeable future. So basically, we have to use the formula of perpetuity. So how can we find it? Take the free cash flows to firm into 1 over R, into 1 over WACC. Simple. So we will take the formula of free cash flows to firm and then we will multiply with 1 over R or 1 over cost of capital. Okay, so we will find the value of business. So how? This divided by this. $425 million is the market value of business. Okay, what we are interested to find? We're interested to find the value of equity, not the value of business. So keep in mind, what is the market value of business? Okay, so market value of business is equal to what? Market value of equity, okay, plus market value of debt. So we are interested to find market value of equity. So we have to rearrange the formula, right? So to find the market value of equity, so we have to find the market value of business and we have to minus the market value of debt. So when we do that, we can find out the market value of equity. Okay, market value of business, we already find out $425 million, and market value of debt, he said corporate debt is 14 million trading at 130%. So basically, it is trading at 30% at premium. Okay, So 14 million into 130%. Okay, 14 million into 130%. 18.2. So market value of equity, 406.8 million is the market value of this company using the free cash flow method. Okay, that is the simple approach we have to use in our exam. Okay, one other point I want to explain you here before moving further, and then we will do a 5 minutes prayer break. Look, you can either find the free cash flow to business, right? If you read BBP, you can find out in term free cash flow to all the investor and free cash flow to equity holder. So maybe you will be given in the exam free cash flow, free cash flows to equity. Okay. If you find, so which is, this is basically after interest payment. Look here in free cash flow to business, we are not deducting any interest payment to bank, to bondholder, whatever. There's a free cash flow available to all the business. So maybe you have given the free cash flow to equity. And then you have to find the, so now it's very easy. You have the free cash flow to equity. No, discounted using cost of equity only. If free cash flow is equity is given, so what rate you will use? You will not use WACC now. So what you will do first, you will find the free cash flow to equity. Then you have to find the cost of equity. So free cash flow to equity into 1 over cost of equity. You will find the market value of equity directly. Got my point? Okay. So if free cash flow to equity is given, then you have to discount it using the cost of equity, not the WACC. Keep in mind. Maybe in the multiple choice question, he will try to trick you. So either we can take the free cash flow to firm, discounted using WACC, and we find the market value of entire business, including equity and debt, and then we subtract the value of debt from here to find the value of equity. Or simply we will take the free cash flow to equity, or he will not use the word free cash flow to equity, he will use the word free cash flows after debt, meaning same thing. So debt is already deducted, interest is already deducted. So this is the free cash flow to equity. So discounted using the cost of equity. First point you need to make in mind. Second point that I want to raise to you is, look, by the way, here it's mentioned that the cash flow will remain same for the foreseeable future. Maybe in the exam he will tell you, okay, these are the cash flows, assuming it will grow with 3% in perpetuity, possible. Then which formula we will use? Perpetuity with growth formula we will use. Look, right now here, the formula that we have to use is, here we have to take the free cash flows to firm and multiply by 1 over R, 1 over WACC. Simple. If the growth is given, let's say he said 5% growth. So into 1 plus G, same. Perpetuity with growth formula you have to use, right? So same free cash flow we will use here, right? In this case, as we estimated here, let's say here, I find the free cash flows, and let's say my WACC is 10%, and I believe my free cash flows will grow every year with 3%. So how we will use? So to find the market value of business, $42.50 into growth over WACC minus growth. That will give you the market value of business. Definitely it will be more than this. because now our cash flows are growing with 3% in that case. Less chances, but he might give you a question like this in multiple choice section A or section B. So be ready for these type of valuation. Look, as I told you, this valuation will give you the maximum value of the business. And this approach can be used to find the entire value of the business or a division of a business. Let's say we have a division, we have a branch, we have a head office, any area, or we have a machine, or we have a product. So we can find the value of it by taking its cash flows and discounting it, right? So this approach can be used. But if I look at the advantages and weaknesses, yeah, it is the best method. Theoretically, is the best method and can be used to find the part of business as well. But problem is, it requires lot of assumptions to find the value of, like, growth. We can estimate a fixed growth. We will assume our cost of capital, our WACC will remain constant in future. We will assume our revenues, cash flows, growth, taxes, tax rate, everything will remain constant. Of course, it's a very challenging task. I'm going to give you a question from here. If you go for the March 2019 exam, you will find a question over here for the business valuation. This is the March 2019. Section B question. Look, here's a question. And what you have to do, find the value of the business on an asset-based valuation. First, we have to do on a net realizable value basis, we have to find the value. Then we have to find on a earning yield method based valuation. So can you please find using the both ways? First of all, find the value of the business using the uh, asset based valuation, and then find using the earning yield base of valuation. I don't know, is it visible or not? If it's not, then you can find in the folder. Okay, try this. A company. Okay, extract from the financial statement of Bluebell Co. A listed company is as follows. We have information. A similar size competitor company has a PE ratio given. This is for, I think, the other method. The competitor believed that if Bluebell Co. has liquidated, property, plant, and equipment would only resale for 600 million only. Okay, so if we want to do net asset method, and he mentioned very clearly here, net realizable basis, right? I mean, if you want to sell the business, then your PPE would only sell for 600 million only. So that means the PPE, which currently value is 768, can only sell for $600 million only. One thing. While 10% of trade receivable would be irrecoverable. So we have receivable. So 10% of this will be how much? 192 into 10%, I think 19.2 million. So $19.2 million are irrecoverable. So we have to find out the remaining one. By the way, goodwill we have to remove because goodwill any internally generated asset we have to remove in this calculation. So what trade receivable value we will get? 192 million minus 19.2. So it is going to give us $172.8 million, right? And inventory would be sold at 30 million less than the book value. So inventory, we have to subtract $30 million less. So 285 minus 30, 255. So look, all of this information he provided us. We don't have to guess anything. Okay, he tell us what will be my PPE value if we sell the business. My bad debt will be 10% of the receivable, and inventory will be sold at 30 million less. So I will find all the assets. Any information for liabilities? No. Okay. So find the total assets and find the total liabilities. And what answer you get using the NRV method here? So 255 plus 600 plus 172.8. I think the total assets we are going to get here are $1027.8 million. Okay. If you count all the assets above, I don't know, I'm wrong, maybe. Check that. And liabilities are, I think this, we have no information mentioned. So this is total liabilities we have, which include all the long-term and short-term liabilities. Yeah. So we will find the net assets using NRV approach. $662 million. So what answer we get? 662, 365.8 million. That is the value of this business. $365.8 million. So C is the answer. Okay, clear? So using the asset-based valuation, the worth of this business is 365. Next, using the earning yield method, value of Bluebell using the EY method. So earning yield method. So what we need here, EPS over market price per share. Sorry, PE, yeah, PE ratio we have. He gave us the PE ratio. He gave us profits. Yeah, he gave us profits. So earning yield formula, you know that earnings, maybe we have growth as well. Our EPS, our earnings, we will take in total and over market price, right? Market price per share. So we have to rearrange it So if you want to find the market value, entire market value, that will give you not market price per share, because I take entire earnings, so it will give you market value of the company. So we have to take our earnings divided by EY. If the growth, we have to subtract growth and add 1 plus G as well. If no growth, then we don't have to, by the way. I think so. In this question, we have profits. 150 million is profit after tax. Do we have any preference shares? I don't think so. So our earnings are 150 million dollar, and earning yield. What is the earning yield of the company? Remember, we discussed one point in the last session. Earning yield is opposite to PE ratio. So if earning yield is not given, PE is given, reverse the PE, it will give you earning yield, right? So we have PE ratio given 12.5 times. So 1 over 12.5 will give you earning yield. 1 over 12.5. 8%. $150 divided by 0.08. 1875 million. C is answer, but I'm not sure. Let me check the answer. Yeah, correct. So it's 1875 million using the earning yield method. So both answers are C. Correct. Question number 23. When valuing Bluebell Co. using asset-based valuation, which of the following statement is correct? Okay, so just understand the question first. So when we are using asset-based valuation, which of the following statement is correct? Number one, an asset-based valuation would be useful for asset stripping acquisition. So what is asset stripping? You have a business in mind. It's maybe your competitor. So, or it is undervalued. So you are going to buy it and you want to sell its asset one by one, and you want to get the net gain from this. So this is called asset stripping. So I think this first statement is correct. So when an asset-based valuation would be useful for an asset stripping acquisition. Yes, I mean if you are going to buy a business only for the sake of selling it, okay, we want to sell it. So asset-based valuation using NRV is suitable. Okay, B co workforce can be valued as an intangible asset. No. Asset-based valuation is ignoring any intangible asset in this calculation. That's the weaknesses of asset-based valuation. We can include only those intangible assets that has a certain market value, right? So most of the cases it is not. So that's why asset-based valuation ignores any intangible assets. So B is not correct. C, asset-based valuation consider the present value of Bluebell Co future income. No, we are not using future income. The price earning method uses the future income and not the present value, by the way. So this statement is entirely wrong. So asset-based valuation considers the total assets and consider the total liabilities. It's ignoring any income stream of the company. It ignores any cash flow stream of the company. So statement C is also not correct. Replacement cost basis provide a deprivable value. Deprivable mean sale value. By the way, we have three methods for asset-based valuation. Replacement cost. Replacement cost is not a deprivable value. Yeah, if you say NRV basis, they use the deprivable value for this company, right? So replacement cost is not the deprivable value. I explain you what is replacement cost of any value, of anything. Like what is the replacement cost of this laptop? If I want to buy the similar laptop with similar conditions, right? So what price I have to pay for this to buy it? This is the replacement cost. So if I want to buy something from the market with the same condition, this is called replacement cost. So this is also wrong. So the answer is, by the way, A, as I discussed with you. Okay, next is the market imperfection. Okay, we haven't done this topic yet. Last, which of the following statement is correct? Okay, DCO is easier to value. What is DCO here? They give me information for DCO. Okay, the last line, the last paragraph. Separately, BCO is considering the acquisition of DCO, which is an unlisted company, which is the supplier of our company. So DCO is our supplier, and we are considering to acquire it. We're considering to buy it. Okay, so what question we have? DCO is easier to value than Bluebell Co because a small number of shares own all the shares. Not likely, but okay, let's look at the other values as well. DCO is a small company, so it does not have any stock exchange listing. So, okay, let's look at B. BCO will have to pay a higher price per share to take control to DCO than if they are buying a minority. By the way, this statement is true. It's general statement. Look, if you are buying a business and you are taking the majority shares, so what will happen? If you are buying 51% shares, no, controls is yours. Okay, so keep in mind when you are going to buy the majority, when you are going to buy the majority, they will ask you to pay extra money for it because you are going to control the business now. Okay, but when you want to remain in minority, you are paying 15%, 20%, 30%, you will still remain in minority. You are not the one who is going to make decision. Then you don't need to pay any surplus in that case. So this statement is look logical to me. If you want to buy the DCO and you want to go for a higher price per share to take control, yes, if you want to take control, they will ask you to pay higher price for it. If you just want to remain as a minority investor, then they will be okay to pay the fair amount as well. But if you want to control the company, they will ask you for extra for that because the control is shifting to you. Okay, first one is again, of course, incorrect then, because a small company is not going to say that it's very easy to find the value. It's very risky, by the way, to find the value of a company for a small company as well. And since it's an unlisted company. C, scrip dividend decrease the liquidity of share. Remember we discussed scrip dividend? First of all, let's understand what is the meaning of liquidity of shares. Liquidity of shares mean how quickly I can sell my share on the stock market. This is called liquidity. I mean how quickly an investor can sell or can release its investment in the stock market. This is called liquidity. So scrip dividend, I don't think so have any effect on the liquidity. What is scrip dividend? Where you give the choice to the shareholder that okay, we can give you cash dividend or we can give you shares as a form of dividend. Yeah, but placing, if you remember, we discussed the term placing before. Placing have an impact on the liquidity. Why? Because when the majority of your share or a long proportion of your shares you placed, what happened? Normally, the institutions, the financial institutions who will buy your shares, they will not trade in the market. So it will slow down the sale and purchase, and of course, the liquidity of the share. But I don't think so scrip dividend have any direct connection with the liquidity of the share. Okay, you understand what's the meaning of liquidity of the share. So the statement C is also wrong. D. D-Co shares will trade at a premium to similar listed share because it has a lower cost of equity. No. D-Co does not have a lower cost of equity. Why? Because D-Co is clearly mentioned is a listed company, unlisted company, sorry. So how could we say that their risk is similar to the other quoted company in the industry? No, it's not. D-Co is an unlisted company, so definitely it has more risk as compared to other listed company. So the last statement is also incorrect. So in that case, the correct statement will become the statement number B. So we understand how to find the value of business using asset based, using earning based, and then lastly using the cash flow based valuation. Now let's learn how to find the value of debt. Maybe we have been asked to find the value of debt. Okay, so this topic is very similar to find the cost of debt. We learn how to find the cost of debt of preference shares, cost of debt of um, bond or loan notes, redeemable loan notes, irredeemable loan notes. So opposite way we can find the market value of the debt. Okay, so we have three type of securities. Let's learn about how to find the value of these three securities, and then we will try some questions for this as well. Number one is preference shares. How to find the value of the preference shares? Simple. So preference shares, what they give you? They give us a fixed dividend. And if it is irredeemable, let's say it's irredeemable preference shares. So take all the dividend payment and discount it. So market value of any instrument is future cash flows and the present value of those future cash flows. So the preference shares, remember we discussed about KP, how to find the KP. It was the dividend over P0, market price. So if you want to find the market price, you have to shuffle it. You have to rearrange the data. Okay, here is the data. So dividend, the preference dividend remain the same. Dividend over KP. Similarly, if you want to find the market value of irredeemable debt, so what is the irredeemable debt? A bond that carry only coupons payment for the foreseeable future. So take the coupon payment, which is interest, okay, into 1 over R or 1 over KD, right? Okay, so into 1 over R or 1 over return holder of the equity, debt holder. Return of a debt holder we will use here to find the value of business. If it's a redeemable debt, then what? Let's say a bond is 7 years redeemables. I mean, after 7 years it will redeem. So take the 7 coupon payment, redemption value, discount it. So the present, so simple and basic idea is take the future cash flows of the related security and take the discounted price or take the present values. So for any security, the value of any security is the present value of its future cash flows. Okay, so let's try this idea. First of all, let's find out, can you find the value of preference shares here? Can you find the value of preference shares here? So D should be in dollars. So 12% into 1 because it's par value. Okay, so you will receive $1 is a par value into 12% of it. and KP is given 14%, required rate of return. So what answer we get? $85.71. This is per share, preference shares value. So it's cent, sorry, 85.71 cents, not dollar, because you use cents here. Or 0.8571, you can say that, right? Okay. Next. So we have to find the value of irredeemable bond. Once again, so to find the value of irredeemable bond, the P naught x interest is equal to, we have to take all the interest amount, not 1 minus t, right? And divided by IR, the rate of return, or you can say KD before tax. You have to use it. So what is the coupon payment? 7%. So 7 into 100, 7. KD is 4% only. That's it. $170. 175. Yeah, 175. That's the market value of this bond. Now, next is redeemable bond. So how to find the market value of redeemable bond? The company has issued 9% redeemable bond with 10 years to redemption. So maturity is 10 years. Redemption will be at nominal value, mean par value. The required return is 16%. What is the market value of this redeemable debt? So take all the cash flows and discount at 16% return of the investor. So we have 10 years. Okay, I will do it here. We can use annuity factor as well. Take all the cash flows here. We have to find the market value, right? So what coupon payment you have? $9 into 100. Okay, so basically you have to pay $9 coupon every time. So interest, don't do 1 minus t. We are not finding the KD, we are finding the market value, right? So we will take the gross interest. We have 10 coupon payments. How much 10 coupon payments we have? $9 into 100, so 9. And then in year 10, it will redeem as well. Okay, so redemption amount. Redemption amount. So what amount you receive at redemption? 100 par value. So we take all these cash flows. Okay, here when you are going to, remember we find the KD of redeemable bond, you have to find the IRR. Then 3 cash flows will be given, market value. Here the market value we have to find. So required return is given. Whenever you have to find the market value, required return is given. So we have to take the discount factor at your required return, whatever is given. So it is how much here? It's mentioned that it is 16%. They require a 16% return. Okay, at 16%. So how we will do it? 1.16 raised to power minus number of years. Okay. And then we will find the present values. And the market value of this bond is this. This is the market value of redeemable bond. PO is this. Is it clear? So simple. Take all the future cash flows and discount it. So present value of all the future cash flows is the market value of the bond. Okay, what about if your bond is convertible? If your bond is convertible, what's the difference then? Maybe it will convert into shares. So again, same idea, same principle. So if you have a conversion option there, see which one is higher. Redemption is higher or conversion is higher. So whichever is possible, we are going to use this in that case. Okay. If conversion is highly likely, then we will take the conversion value here. If what we call this, um, if redemption is highly likely, then you will take the redemption value here in this case. Rexel Co. has in issue convertible loan notes with a coupon rate of 12%. 12% is the coupon rate. Each 100 loan notes may be converted into 20 ordinary shares at any time until the date of expiry, and any remaining loan note will be redeemed at 100. So the investor have a choice to convert into shares anytime, okay, or they can redeem the $100 back. The loan notes have 5 years left to run. Investor would normally require a return of 8% per year on a 5-year debt security. Okay, should investor convert if the current share price is $4 or $5 or $6? Okay, look, you have two options as a bondholder. You can redeem your money, redemption, if you can redeem your money, so you can get redemption value, or you can convert and get the conversion value. So if you redeem, you can redeem for $100, any investor. If he want to convert, then how many shares he will get? He mentioned he will get 20 shares. He will get 20 shares. And it depends on what will be the price of one share on that day. If price of one share is $4, then how much share he's going to get? Only 80. If the price he mentioned maybe $4, maybe $5, maybe $6. If the price is $4, then how much he is going to get if he convert? Then he will get only how much? He will get only 80, which is not acceptable, by the way. So in that case, in first case, the investor will prefer to redeem $100 back. In second case, he will, let's say the price is $5. So 20 shares into $5. So I think $100. So by the way, same. So investor is indifferent whether he will go with the conversion option or not. His worth is going to remain the same. Third is if the share price grows to 6. So 20 shares into $6. Yeah, that is the valid option. The bondholder will prefer to convert the money into shares if the market value grows at $6 per share, because at this time the investor can get a bonus of $20, a premium of $20 on their investment. Okay, so simple. So this is an easy question, by the way. But here we have to find the market value. The next question here, we have to find the market value of the bond. Okay, calculate the market value of the $100 convertible bond. What? We have to find market value, we have to find floor value, we have to find conversion premium. How to solve it? Okay, so what we have to do, we have to find the market value here of the convertible bond. PCO has in issue 8% bond. 8% is the coupon with the redeemable at their nominal value of 100 in 3 years time. So we have only 3 years of cash flows here. We have only 3 years of cash flows here. So what is the coupon payment? 8%. So 8% definitely should be on a par value. So coupon is always on par value, which is 100. It's mentioned. Even if it was not mentioned, we believe that it is 100. So $8 of coupon you receive every year. 888. And then after that, bond may be converted into 30 shares or it will be redeemed at their par value. Okay, so we have two options. Okay, so we have two options. One, it could be redeem at par. This is how much? 100. And number two, conversion value. Okay, so which one is higher? We will take it. So he said each bond may be converted into 30 ordinary shares. And the current ordinary share price of our company is 3.3. But it is expected to grow at 5% for the foreseeable future. So current current price is 3.3, but it is expected to grow at 5%. Okay, so 3.3. Okay, conversion value is 3.3 is the price per share now, but it will grow every year with a constant rate. We assume that this will grow at 5% for the foreseeable future. So we need only for 3 years because this bond have a life of 3 years. So into 1.03, sorry, how many? 5 raised to power 3 years. So expected price of the share is 3.82. How many shares we offer them? 20. So 20 multiplied by this. 30? Oh, sorry. So conversion is expected because conversion value is higher. Conversion value is higher than redemption value. So conversion is expected here. So we will replace the redemption amount to conversion amount. What is this? So which one is higher? Redemption value, conversion value, which one is higher? We are going to use it here. Okay. And then what is my discount factor? He tell us here. The debt holder require a return of 6%. So 6% is the KD, is the return of the investors, 6%. 1.06 raised to power minus. So that's the market value of the bond. How much? 117.61. Is clear? Now, what he asks else, first of all, he said, find the market value. So I find the market value already. Next thing is find the floor value. What's the floor value? Remember? The minimum value, the other value. So, okay, how can we find the floor value? Okay, just replace conversion amount with redemption amount and you will find the floor value. Okay, by the way, this is what I find. True. Let me put it as a text. Okay, now I want to find the floor value of the bond. Okay, we expected that the bond is going to convert. And if it's converted, the value that we get is this. But what if bond will not convert it? The minimum value we need to find how. Then conversion amount we have to replace with redemption amount, which is 100 now. So in that case, what answer you are going to get here? I think that is the floor value you have, floor value of the bond. And what is the extra premium? The investor conversion premium. Of course, the conversion will get a premium by the difference. Look, if you will decided to redeem the money, you will get this much money. If you decided to convert your share, you will get higher money. So what is the premium that investor have to bear the difference? $12.26 per bond. That is the additional benefit they will get per share, per bond, sorry. Okay, so that's the kind of a question you might expect it to see in your exam. So that is the end of this section, except some theory, okay, like market efficiency theory. But what is the idea behind this theory? It's about the share price of a company. Let me ask you some questions regarding that. I hope you are all aware about that. Why the share price of a company not remain constant in the stock market? Why the share price of any company is fluctuating on the stock market? Right? Anyone? Demand and supply forces. So share price of any company, why it's fluctuating, the basic factor, the basic reasoning, the prime reasoning behind it is demand and supply forces. So it's not this economic concept, it's not only applicable to shares, but it is also applicable to any commodity or any instrument in this world, right? Sugar, fuel, currency, stocks, right? Any kind of stocks, any kind of instrument in the world, why is price fluctuating? The prime reason is demand and supply. But what is the driving factor behind demand and supply? There are many, there are too many. Number one, public expectations. What public perceive, right? They will act. Yeah, power of purchasing as well. Inflation, you can say that. Inflation of the country, we can not ignore it. Economy of the country, the public perception, what public perceive about it. political scenario of the country, economic stability of the country, all of these matters. Like let's say what happened in between when the Ukraine and Russia they start a war, how it impact the stock market at that time, right? Right now, recent example, the DeepSeek, the news, AI from China was generated, how it affect the US market. Why? Because people expectation will change. If the majority of the people will start thinking about something, they will act accordingly. I mean, let's say a company is going to make an investment. Okay, let's say a company is just thinking of making the investment. If the majority of the people think, no, this is a wrong investment, this investment they should not go for, they should not take over the competitor or whatever. If majority of the people think about it, what they do? They prefer to sell their investment if they're not happy. Even that investment may be good for the company, but what they perceive, they act on their perception. And what happened? The market price dropped. The second point I want to raise here, and we already discussed this a lot of time before. When I started the business valuation chapter last session, I discussed with you the market price of a company share is not its true reflection. So, I mean, if a company share price is trading at $10, basically, let's say they have 1 million share, so the market cap of the company is 10 million. So, whether it's a true reflection of the company wealth? No. Why? Because it is affected with demand and supply. That's why we have to find different ways to find the value of business. Okay, so market efficiency, this idea is basically applicable to stock market efficiency. So a stock market, how efficient it is. So what is the efficient stock market? Any stock market where the investor, any stock market where the information spread quickly like this, that market is efficient market. Simple. Nowadays, almost all the stock market in the world are very efficient stock market, thanks to technology, right? Thanks to internet, thanks to these things. So information that we want to access nowadays is not costly, normally free. Okay, so what is the efficient market? Is a market where, as an investor, if I want to obtain any information, I can access it very easily, right? I don't have to pay any cost to get this information. So an efficient market is one in which securities price fully reflect all the available information. Look, this is the key point. So keep in mind, whenever any information comes related to any specific company or related to any specific industry, it will affect, it might affect in the positive way, it might affect in the negative way, but it will affect the company share price. Nowadays, all the markets are efficient. So whenever the company announce the dividend, share price go up. Whenever the company announce we are going for this restructuring plan, whatever news comes in the public will react accordingly. It depends what public will perceive, right? What public will perceive, but what majority will react. If the majority of the people sell your shares, so your price will go down, and vice versa. Now, we have three types of market. I'm just giving you a small introduction about it, and then we will start this topic in next. We have three types of market in the real world. You can say that a weak form efficient market, a semi-strong, a weak efficient market, a semi-strong form market, and a strong form market. So keep in mind, we are talking about the stock market. Weak form efficient market, where the market reflect only when the past information become public. I mean, in a weak form market, Public only knew when something is publicly announced on a newspaper. Okay, I read the newspaper, the company is going to make this bid, then I react. I have no idea right now. So weak form efficient is a market, very weak market, where only public knew about the past information. They only have the past information. On the other side, strong form efficient market is a market where public have past and present information as well. So a strong form is a form of efficiency where public have all the public and private information. Private means if company have any confidential information, the public knew about it. So a strong form efficient market possible? I don't think so it's possible. It's not possible that company management are just thinking of giving dividend. You don't know about it. You're not sitting under the table of the director. You don't know about it, right? But somehow it present because director know about it. And if they want to exploit this, they can do it, right? You have a lot of movies in Hollywood and Bollywood you can watch about this, where what they try to do, they try to exploit this very kind of private information. But yeah, from that perspective, we can say that a strong form efficient market might exist, right? So most of the market in this world, they don't have weak form of efficiency. They don't have a strong form of efficiency. They have the semi-strong form of efficiency. So we can say that what stock markets we have nowadays, they have a semi-strong form efficiency. So what they have all public information, including past share price movement. So whatever information which is publicly available through newspaper, through announcement, through company. So whenever they become public, people knew about it and they will react immediately about it. Okay, so in next session, we will discuss what will be the implication of these market, what the directors should do if they are in a weak form efficient stock market, or if they are in a semi-strong form efficient market and strong form efficient market. So this is just a theoretical portion, but it's always tested 3 marks, 4 marks in the exams. Okay, basically market efficiency, the idea behind it, how market is able to absorb the information quickly. Like, so whenever a new information become public, the investor will react, right? Investor might react in a positive way, in a negative way. We're talking about which market? We're talking about stock market. When I come to know that Apple is going to make a good decision, or Apple is going to announce a new product, they're going to launch a new model, they're going to make a new venture, and I believe that this is going to be a good investment, so I would like to invest in Apple stocks, right? By buying new shares. So I react and people will react. And vice versa. Okay, the topic that we were on was the 3 different form of efficiencies that market possess: weak form efficiency, semi-strong form efficiency, and strong form efficiency. Okay, what is the weak form of efficiency? We discussed a weak form efficiency mean a market only absorb the past information which is mainly the past financial statements. Let me read it. Let me allow you to read just few things from here. So what is in the weak form? So it said in a weak form efficient market, share price reflect information about all past price movement. So only the past price movement. So that means the past movement do not help in identifying positive NPVs. So look, if you are in a weak form efficient market, then let's say your management is deciding to go with a new project which has a positive NPV, it is not going to affect your stock price. Why? Because public don't know about it. Public don't have the publicly available information, right? So keep in mind, when you are in a weak form efficient world, when your stock market is weak form, then public will not react with the new changes. They will only react when they come to know after 1 year or after some reasonable time. Okay, so they mentioned that in this case, share price follow a random walk. What that mean? There's no pattern or trend. When you have a weak form efficient market, these trends are not going to impact your market because market is very slow, weak form. Then we have semi-strong form efficiency. So in semi-strong form efficient market, the public know about the past information plus also the publicly available information. Any information which become public, like the company make a announcement through press release or on their website that we are going to initiate a project, we are going to take over our competitor, whatever, we are going to take over our this company as a subsidiary, we are going to invest in this new projects, right? Whatever. So we are going to make a dividend payment, or we are going to restructure our business, are we going to, like, we are going to make some major modifications. So whatever they announce, the market will react immediately. So publicly available information is also there. So in a semi-strong form efficient market, the share price incorporates all past information and all publicly available information. Okay, so public know whatever happened in the past and whatever is publicly available, whatever available on the media, whatever available on the internet, whatever published in the newspaper, whatever published on the websites. Okay, so public knew about it, and when they knew, they will absorb it immediately and they will react immediately. React in both ways, in positive way or in negative way. Okay, so in that case, any trending might helpful. But look here again, no one can exploit the market. I mean, look, let's say company is going to make a dividend announcement. So when the company make announcement, right, price will alter automatically. Price will increase automatically. So in the meantime, no one can get the benefit. Look, I don't know. Let's say I'm a shareholder of a company. Okay, I was waiting the company is going to make an announcement for dividend and I will sell my share. Why? Because when the company make the announcement of share price temporarily will increase. And I will exploit this opportunity and I will sell. Right? But I cannot exploit. Why? Because everyone in who is having the public information, they knew about it. Yeah, maybe in the first few minutes when they just make the announcement, so maybe in first few minutes I can exploit the opportunity, right? And I can buy more shares. Okay, basically I want to buy more share in that case. I know that the company is going to make an announcement of dividend, so better to buy share. And when the dividend will announce, after a few minutes, after 1 hour, I will sell share. Okay, I can get my benefit within no time. I can get my benefit. If I knew that company is going to make a new decision, they're going to make a restructuring decision. So when I come to know, everyone come to know, right? So how can I exploit it? I cannot exploit it. Maybe in the first few minutes, before someone else is going to react, I react. I might get some advantage of this. But in long term, I'm not going to get any advantage from it. And lastly, we have strong form efficiency, where we believe that the market know everything about the company, even the insider information or private information as well. Directors, they have the insider information, but they cannot exploit it. We discuss about this in our last session as well. No, I want to do some question with you. What would you believe about the efficiency of the market, means stock market, if you thought you could make money by insider dealing? So in which kind of a market you can do insider dealing only when it is having a strong form efficiency, because insider dealing mean when you know something about the company inside which is not publicly announced yet, right? By the way, it is illegal. Who can do this? Only the directors can only do this through their relatives, agent, whatever, if they want to exploit it. But so if you are going to do insider dealing, that means this kind of market is strong form efficient market. Analyzing past price movement, this is a strong form efficiency. So past price movement, analyzing, and on the basis of that, you want to react. Only this is possible in today's market, strong form efficient, sorry, semi-strong form efficient market. Okay, only by pure luck, again, this is the strong form efficiency. In strong form efficient market, you cannot exploit the market. That's what I'm trying to explain you. Yeah, pure luck is there. Maybe you have a luck and you exploit the market. You thought something and the same thing has happened, right? But you might make a loss as well. Last, analyzing the financial statement, director statement, company activities, etc. I think this is the uh, weak form efficient market, because you're just looking at the financial statements and stuff only.